So you want to own a toll road. Cars drive on it, you collect money, they can't take another route without adding an hour to their commute, so they pay whatever you charge. No inventory, no customer service line, no competitors, because nobody's building a second highway next to yours. Just a strip of asphalt that prints money every time a car crosses a sensor. It sounds like the closest thing to a legal monopoly a private investor can buy. Traffic grows every year. People need to get to work regardless of the price of gas or the state of the economy. And once the road is built, the marginal cost of one more car driving across it is close to zero. So why isn't every billionaire on Earth buying highways? Because building one costs billions of dollars you won't see back for decades. Because governments can cancel your contract, freeze your rates, or build a free road right next to yours. Because the traffic projections that justified the entire investment are often wrong, sometimes catastrophically wrong. Because a business that looks like a monopoly on paper is, in practice, one of the most politically exposed investments in the world. On paper, this looks perfect. A fixed asset, a captive customer base, decades of guaranteed cash flow. Reality is very different. Every few years, a toll road operator goes bankrupt. Not because people stop driving, because the numbers behind the deal were wrong from day one, and nobody wanted to admit it until the debt payments came due. Meanwhile, other operators, the ones who understood the real mechanics of this business, have turned single roads into multi-billion-dollar fortunes that get passed between pension funds and sovereign wealth funds like blue-chip stocks. So what's the difference between the toll road that makes a fortune and the one that goes bankrupt? Where does the money actually come from? And is this a real business or just a very expensive bet on a spreadsheet? Let's go back to where this all started. The idea of paying to use a road is ancient. Roman roads had tolls, medieval bridges charged crossing fees. But the modern version, the one built around massive infrastructure and long-term private contracts, starts in Italy after the Second World War. Italy needed to rebuild its shattered road network fast, and the government didn't have the capital to do it alone. So it granted private and state-owned companies long-term concessions, the right to build a highway, operate it, collect tolls, and eventually hand it back, decades later. France and Spain copied the model in the 1950s and 60s. Companies like Vinci and Eiffage in France, and later Sintra in Spain, grew directly out of these early motorway concessions. The idea eventually crossed the Atlantic, but American toll roads took a different path for most of the 20th century. States like Illinois, New Jersey, and Indiana built their own turnpikes using public bonds, and government agencies ran them directly. Private ownership of American highways was rare until one deal changed everything. In 2005, the city of Chicago leased the 7.8-mile Chicago Skyway to a consortium of Sintra and Macquarie for 99 years. In exchange, the city received approximately $1.83 billion up front, cash it used to pay down debt and fund city programs. The private operators got the right to every toll dollar on that bridge for the next century. This is where the business becomes interesting, because the Skyway deal proved something nobody had proven in America before. Investors would pay enormous sums, upfront, in cash, for the right to a future stream of toll revenue they didn't yet control. A year later, Indiana went further. It leased the 157-mile Indiana toll road to the same Sintra-Macquarie consortium for 75 years, collecting $3.8 billion up front. At the time, the largest highway privatization in American history. Governor Mitch Daniels used the windfall to fund transportation projects across the state without raising a single tax. Politically, it looked like magic. Financially, it was a bet that decades of toll revenue would be worth more than $3.8 billion in today's money. A bet the private consortium was confident enough to make, and a bet that 8 years later blew up spectacularly. We'll get to why. Today, who actually buys these assets? Not individual investors. This is a game played by infrastructure funds, pension systems, and sovereign wealth funds. Organizations like Macquarie Asset Management, IFM Investors, Australia's superannuation giants, and Canadian pension funds like OMERS and CPPIB. They like toll roads for the same reason insurance companies like annuities: long duration, inflation-linked, relatively predictable cash flow that matches liabilities stretching decades into the future. A toll road doesn't need to beat the stock market. It needs to reliably pay out for 50 to 99 years, and that's exactly what a pension fund needs to match against retirees who are going to keep needing checks for the next several decades. Now let's talk about what it actually costs to get into this business, because the number at the front end is staggering. Building a new highway from scratch in the United States runs, depending on terrain and urban density, somewhere between $5 million and $25 million per lane mile for a standard freeway, and significantly more, sometimes over $100 million per mile, for elevated or tunneled urban expressways. Georgia's SR 400 Express Lanes project outside Atlanta, a public-private partnership that broke ground in early 2026, carries a total cost of approximately $4.6 billion for a stretch of managed toll lanes, financed through a mix of $3.4 billion in private activity bonds and a $4 billion federal TIFIA loan. The private consortium building it, a partnership of Meridiam, ACS, and Acciona, paid the state of Georgia a $3.8 billion upfront concession fee just for the right to build and operate it. That's before land acquisition, which in dense metro areas can rival or exceed construction costs. Before environmental permitting, which can take 5 to 10 years for a major new corridor. Before the engineering studies, traffic forecasts, and public hearings required before a single shovel goes into the ground. And before financing costs, because almost nobody builds one of these with cash. These deals are financed with a layered mix of public bonds, private equity, and government-backed loans, and the interest on that debt accrues for years before a single toll payment arrives to offset it. So here's the problem. You're several billion dollars in, a decade into planning and construction, and the entire value of the investment depends on a forecast. How many cars will actually use this road 20, 40, 60 years from now? Get that forecast wrong, and everything downstream collapses. But when it works, the revenue model is elegantly simple, and understanding it explains why investors are willing to wait decades for a payoff. The core revenue is the toll itself, typically priced per mile or per crossing, varying by vehicle class. On the Indiana toll road today, a full 157-mile trip costs a passenger car approximately $16 and a heavy truck close to $88. Trucks pay dramatically more because they cause disproportionately more wear on the pavement and because freight companies have fewer free alternatives. Trucking revenue is often the most valuable part of a toll road's income because logistics companies value time savings and reliability far more than an individual commuter does, and they'll pay a premium for a predictable route. Increasingly, operators are also running managed lanes, express lanes with dynamic pricing that rises and falls based on real-time congestion, sometimes reaching $10 or more per trip during rush hour on corridors around Washington, D.C. and Northern Virginia, largely operated by the Australian company Transurban. This is where the real innovation in toll pricing has happened over the last 15 years. Instead of a flat fee, dynamic pricing lets operators extract maximum value from drivers who are willing to pay to save time, while still leaving free lanes for those who aren't. It's a form of price discrimination that would be nearly impossible to execute in most other industries, but drivers accept it because the alternative, sitting in traffic, has a real cost too. Beyond tolls, operators earn smaller but meaningful revenue from service plazas, advertising along the corridor, and in some cases fiber optic easements, since highway rights-of-way are valuable corridors for laying telecommunications cable. None of this comes close to toll revenue in scale, but it adds up over a multi-decade concession. Then there's operating cost, and this is where fixed costs start to dominate the entire economics of the business. Pavement doesn't maintain itself. Resurfacing a major highway costs millions of dollars per mile and needs to happen roughly every 10 to 15 years, depending on traffic volume and climate. Bridges need structural inspections and periodic rehabilitations that can run into the tens of millions of dollars for a single major span. Snow removal, lighting, signage, toll collection technology, and staffing all add up. But the bigger issue is that most of these costs don't scale down when traffic is light. Whether 40,000 cars use the road today or 25,000, you still have to plow the snow, staff the operations center, and pay down the same debt. That's the defining risk of every toll road. Revenue is variable, but costs and debt service are largely fixed. This is exactly what destroyed the Indiana toll road's original owners. The 2006 lease priced the deal based on optimistic traffic projections made before the 2008 financial crisis. When the recession hit, freight traffic, the most profitable segment of the road's revenue, collapsed. Truck volumes never fully recovered to the levels the original financial model assumed. The private operator ITR Concession Company had taken on enormous debt to fund the $3.8 billion upfront payment, and with revenue falling short of projections year after year, it couldn't service that debt. In 2014, ITR Concession Company filed for bankruptcy. The debt was restructured, and in 2015, the Australian fund IFM Investors bought the concession outright. The road itself never stopped operating. Drivers never noticed. But the original investors lost their equity, wiped out by a traffic forecast that turned out to be wrong by a wide enough margin to sink a multi-billion-dollar company. The lesson echoes across the industry. In Texas, the Camino Colombia toll road, built in the late 1990s to serve truck traffic near Laredo, opened to a fraction of the volume its developers expected, went bankrupt within 3 years, and was eventually bought by the state for pennies on the dollar. In Australia, Sydney's Cross City Tunnel and Brisbane's Clem 7 Tunnel both went bankrupt within their first years of operation after actual traffic came in at less than half of what their financial models predicted. Investors and lenders in both projects lost hundreds of millions of dollars. In every one of these cases, the road itself worked exactly as engineered. The failure wasn't concrete and asphalt, it was the spreadsheet. Compare that to the success stories. Toronto's Highway 407, leased in 1999 for 99 years in exchange for roughly 3.1 billion Canadian dollars, became one of the most profitable infrastructure assets in the world, owned today by a consortium including Spain's Sintra and Canadian pension funds. Traffic and toll rates have both grown steadily for over 2 decades, and the asset has been valued at more than $30 billion in recent transactions, nearly 10 times what investors originally paid for the concession. The difference between the 407 and Indiana wasn't luck. The 407 serves one of the fastest-growing metro regions in North America, and its owners had the contractual freedom to raise tolls aggressively without needing government approval, a level of pricing power the Indiana toll roads operators never had. And that's when everything falls apart, or comes together depending on one variable investors obsess over more than any other: how much control you actually have over pricing. This is the core of toll road economics, and it explains almost every success and failure in the industry. Margins can look extraordinary. Mature toll roads often report operating margins above 60%, because once the road is built, the incremental cost of another car is close to nothing. But that margin means little if the concession agreement caps how much you're allowed to raise tolls, or if a government decides, under political pressure, to freeze rate increases during a cost of living crisis. Every toll road deal is, at its core, a negotiation over exactly how much pricing power the private operator retains, and exactly how much political risk the government keeps for itself. Debt defines everything else, because these assets are financed with enormous leverage, often 70 to 80% debt. Small shortfalls in projected revenue get magnified dramatically at the equity level. A road that misses its traffic forecast by 15% might still be a perfectly functional piece of infrastructure, while simultaneously wiping out its equity investors, because all of that shortfall hits the thin sliver of ownership sitting below a mountain of debt. Regulation is the wild card that never fully goes away. Some concessions grant the operator near total freedom to set prices, indexed to inflation, locked in by contract for decades, the kind of agreement investors dream about. Others require government approval for every rate change, exposing operators to the whims of whichever politician happens to be in office when the request comes up. Indiana's operator recently agreed to pay the state $700 million over time in exchange for the right to raise tolls twice a year instead of once, a reminder that even seemingly private pricing power often has to be renegotiated with the public sector that never fully lets go. Now, where is this industry heading? Electric vehicles complicate long-term revenue models built on fuel tax-adjacent assumptions, but tolling itself is largely fuel-agnostic. A Tesla pays the same crossing fee as a gas-powered sedan, so toll roads are, if anything, more insulated from the EV transition than gas stations or fuel tax-dependent state budgets. Autonomous vehicles could eventually change traffic patterns in ways nobody has fully modeled. Will self-driving cars increase highway usage because commuting becomes more tolerable, or decrease it because ride-sharing and platooning make each trip more efficient? Nobody actually knows yet, and every long-term valuation in this industry is quietly making a bet on the answer. Government financing tools are also expanding. In 2025, the U.S. federal government raised the TIFIA loan program's coverage from 33% to 49% of total project costs, making it easier to finance new toll roads with lower-cost federal debt instead of expensive private capital, a shift that could bring construction costs down and make new projects more financeable over the next decade. At the same time, urban politics are shifting against new highway expansion in some markets, with congestion pricing and managed lanes increasingly favored over building brand new corridors, especially in cities focused on reducing emissions. So, should you buy one? If you're a pension fund with a 50-year time horizon and the patience to absorb a decade of construction risk before revenue arrives, toll roads can be one of the most reliable, inflation-protected assets available anywhere in the world, proven repeatedly by assets like Highway 407, which turned a multi-billion-dollar concession fee into one of the most valuable infrastructure holdings on the planet. But this is not a business for anyone chasing quick returns or assuming the monopoly story tells the whole picture. The real risk was never competition. It was the accuracy of a traffic forecast made years before a single car crossed the road, financed with debt that doesn't care whether that forecast was right. Toll roads don't fail because people stop driving. They fail because someone, years earlier, believed a number on a spreadsheet a little too confidently. The road itself doesn't lie. It just sits there, collecting exactly as much as the traffic that actually shows up is willing to pay. Everything else, the billions in concession fees, the decades-long leases, the fortunes made and lost, comes down to whether the people who built the model got that one number right. So you want to own a seaport, have ships arrive from every corner of the planet, they have nowhere else to go. The nearest alternative port might be 500 miles away, adding days and hundreds of thousands of dollars to a shipping company's costs. So they pay your fees. Every container that touches your cranes generates revenue. 90% of everything humans buy travels by sea at some point, and that cargo has to land somewhere. It sounds like the ultimate toll booth. Global trade only grows. Ships keep getting bigger. Consumers keep buying more. And unlike almost any other business, your customers, some of the largest shipping companies on Earth, have almost nowhere else to go. So why don't more people own ports? Because building one costs billions of dollars and takes over a decade. Because you don't actually own the water, the land, or often even the cranes. You're leasing rights from a government that can change the terms whenever it wants. Because a single geopolitical decision in a country you don't operate in can reroute global shipping lanes and leave your multi-billion-dollar terminal half empty. Because the business isn't really about ships, it's about logistics, labor, and land. Three things that are far harder to control than they look from the outside. On paper, this looks perfect. A monopoly on the physical gateway of global trade. Reality is very different. Ports have bankrupted operators, triggered international incidents, and in at least one case, cost a country its own coastline for the better part of a century. Meanwhile, a handful of companies have quietly built empires spanning dozens of countries, generating billions in annual profit from an asset most people never think twice about: the concrete apron where a crane picks up a box. So who actually owns the ports the world depends on? How does a business built on giant steel boxes actually make its money? And is this a genuine investment opportunity or one of the most misunderstood businesses in the global economy? Let's start with how this industry actually came to exist. For most of history, ports were simply owned and run by governments, extensions of the state, treated the same way as a military base or a customs house. That began to change in the 1960s and 70s with a quiet invention that reshaped global trade more than almost anything else in the 20th century: the standardized shipping container. Before containerization, loading a ship took days, dozens of dock workers, and enormous manual labor. After it, a crane could move a 40-foot steel box in under 2 minutes. Ports that adapted fast and built the infrastructure to handle these boxes at scale became indispensable. Ports that didn't became irrelevant almost overnight. This created an entirely new kind of business: the container terminal operator. Companies like PSA International, born out of the Port of Singapore Authority, and Hutchison Port Holdings, built out of Hong Kong, realized that operating a terminal efficiently was a specialized skill governments weren't always good at. Through the 1990s and 2000s, a wave of privatization swept the industry. Governments, especially in developing economies, began granting long-term concessions: the right to build, operate, and profit from a terminal for 20, 50, sometimes 99 years. In exchange for private capital and expertise they didn't have themselves. This is where the business becomes interesting, because port ownership today isn't really about owning land. It's about owning the concession, a contract that grants exclusive rights to operate a piece of a port for a defined number of decades, after which everything typically reverts back to the government. Today, the industry is dominated by a small number of global terminal operators: PSA International out of Singapore, DP World out of Dubai, APM Terminals, the ports arm of Maersk, Hutchison Ports out of Hong Kong, COSCO Shipping Ports, backed by the Chinese state. Together, these companies operate terminals across dozens of countries, and increasingly, financial investors have joined them. Infrastructure funds like Macquarie, which took a 50% stake in Australia's Patrick Stevedores in 2025, and Stonepeak, which partnered with shipping giant CMA-CGM to build an entirely new global ports platform. This is no longer just an industrial business. It's become one of the most sought-after asset classes in infrastructure finance. So what does it actually cost to get into this business? A modern container terminal, built from scratch, with deep-water berths capable of handling today's largest vessels, easily runs into the billions. Egypt's new Red Sea container terminal at Ain Sokhna, developed by a consortium of Hutchison Ports, CMA, CGM, and COSCO, represents part of a broader $1.8 billion investment program built over 2 decades. Smaller expansions still carry enormous price tags. A single new terminal concession in Saudi Arabia's Jubail commercial port, signed in 2026, is expected to generate approximately $528 million in private investment just to lengthen the quay and deepen the berth. And that's before the cranes. A single modern ship-to-shore gantry crane, tall enough to service the largest container ships afloat, costs somewhere between $10 and $15 million, and a serious terminal needs a dozen or more. Dredging the harbor deep enough for today's mega ships, vessels that can carry over 24,000 containers, can cost tens of millions of dollars on its own, and it often needs to be repeated every few years as sediment refills the channel. Add labor agreements, often negotiated with powerful longshoremen's unions, that can shut down an entire coastline with a single strike. Add customs infrastructure, security compliance, environmental permitting that can take a decade in developed countries, and the capital cost of holding enormous tracts of waterfront land that produce nothing until the terminal is operational. So here's the problem. You've committed billions of dollars and a decade of planning to a fixed piece of infrastructure that cannot be moved, cannot be resized easily, and is entirely dependent on shipping routes that are decided by other people, shipping alliances, global trade agreements, and geopolitics you don't control. But once it's running, the revenue streams are genuinely diverse, and understanding them explains why this business, done right, generates extraordinary cash flow. The core revenue is the terminal handling charge, a fee charged per container, whether it's being loaded or unloaded, typically ranging from roughly $100 to over $300 per 20-foot container, depending on the port and region. On top of that, ports charge dockage fees for a ship simply occupying berth space, pilotage fees for guiding vessels through the harbor, and storage fees when containers sit in the yard longer than the free allowance. Often the most profitable line item on the entire balance sheet, because a delayed customer pays escalating daily fees for space that costs the port almost nothing to provide. Beyond the core terminal, ports increasingly earn revenue from adjacent real estate, warehousing, logistics parks, and rail connections that let a port capture value not just from unloading a container, but from everything that happens to it afterward. The Port of New York and New Jersey, the busiest port on the East Coast, moved approximately 8.7 million containers in 2024, generating value tied to roughly $264 billion worth of goods passing through, and in 2025 extended its lease with terminal operator APM Terminals for 33 years, a clear signal that both sides view the underlying real estate as valuable for decades to come. Then there's operating cost, and this is where the fixed cost nature of the business becomes brutal. Labor is often the single largest expense, and it's largely fixed regardless of how many ships arrive in a given month. Longshoremen unions in major ports, particularly in the United States, negotiate contracts that guarantee wages and staffing levels years in advance. Equipment maintenance is constant. Cranes, yard tractors, and automated systems require specialized technicians and replacement parts that don't get cheaper with scale. Dredging, as mentioned, is a recurring capital cost, not a one-time expense, because harbors silt up naturally and ships keep getting larger, requiring deeper channels every decade or so. Insurance is enormous, given the value of cargo passing through at any moment and the catastrophic cost of an accident. And nearly every major terminal is financed with substantial debt, meaning interest payments continue whether cargo volumes are up or down. This is exactly what makes ports uniquely exposed to something most businesses don't have to think about: geopolitics. Consider the port of Piraeus in Greece. During the European debt crisis, Greece was under enormous pressure to raise cash and reduce state ownership of assets. In 2016, China's COSCO Shipping acquired a majority stake in the port for approximately €368.5 million, later increasing its holding and pledged hundreds of millions more in investment. What had been a struggling, underused port transformed within a decade into one of the busiest container hubs in the Mediterranean, and one of the clearest examples of a foreign state-backed operator turning a failing asset into a strategic success, while also becoming a lightning rod for debate in Europe about how much control a foreign government should have over critical infrastructure. Now consider Hambantota Port in Sri Lanka, the case study every port finance course now uses as a cautionary tale. Sri Lanka borrowed heavily from Chinese state banks to build the port in the 2000s, betting on traffic projections that never materialized. Ships simply didn't come in the volumes the model assumed. Unable to service the debt, Sri Lanka handed China Merchants Port a 99-year lease over the facility in 2017 in exchange for approximately $1.1 billion used to shore up the country's finances. The port itself works fine. The failure, just like with so many toll roads and highways, wasn't the concrete. It was a demand forecast that turned out to be wrong, financed with debt that didn't care about the difference. And then there's the disruption nobody can plan for. In 2021, a single container ship, the Ever Given, ran aground and blocked the Suez Canal for 6 days, delaying an estimated $9.6 billion of trade per day and forcing ships to reroute around the entire African continent. In 2023 and 2024, Houthi attacks on shipping in the Red Sea pushed a large share of Asia-Europe trade away from the Suez Canal entirely, adding roughly 10 days to journeys that used to take weeks, and dramatically shifting revenue away from ports along that route toward ports along the longer Cape of Good Hope journey. A port's fortunes can rise or fall based on decisions made thousands of miles away, in conflicts that have nothing to do with shipping at all. The numbers tell a different story, depending on how exposed a given port is to a single trade route, a single customer, or a single government relationship. Now let's talk about the actual economics of this industry, because the margins here can be extraordinary. Mature, well-utilized terminals often generate operating margins above 40%, since once the infrastructure exists, the marginal cost of handling one more container is small. But utilization is everything. A terminal running near full capacity is enormously profitable. The same terminal running at half capacity, with the same fixed debt and labor costs, can lose money every single month. This is why port operators obsess over securing long-term contracts with major shipping alliances. Locking in guaranteed volume is worth more than almost anything else in this business, because it converts a variable, unpredictable revenue stream into something closer to the toll road model investors actually want. Competition looks different depending on where you are. In a country with one major deepwater port, that operator effectively holds a regional monopoly. But globally, shipping companies have real optionality. A shipping alliance can shift cargo from a congested, expensive port to a competitor 200 miles away if service and pricing don't stay competitive, which limits pricing power in a way pure monopolies don't experience. Regulation adds another layer. Many governments cap tariffs terminal operators can charge or require domestic labor agreements that limit automation, precisely because a port failure ripples through an entire national economy. So, where is this industry heading? Automation is already reshaping the labor equation. Fully automated terminals, cranes, and yard vehicles run by software rather than people are operating today in ports like Rotterdam and parts of China, cutting labor costs dramatically but requiring enormous upfront capital and, often, politically difficult negotiations with unions who see automation as an existential threat to dockworker jobs. Climate change adds a different kind of risk. Rising sea levels and more intense storms threaten low-lying port infrastructure worldwide, and insurers are beginning to price that risk into premiums. Trade policy remains the biggest wild card of all. Tariff changes, sanctions, and shifting alliances between countries can redirect entire shipping routes within a matter of months, something no amount of concrete and crane capacity can protect against. Consolidation is also accelerating. In 2025 and 2026, financial investors deepened their involvement across the sector, even as geopolitical scrutiny slowed some of the largest deals. A proposed sale of Hutchison Ports' global terminal portfolio drew regulatory pushback from multiple governments concerned about foreign control of strategic infrastructure. A reminder that in this industry, the biggest risk to a deal often isn't the price, it's politics. So, should you buy one? If you have the patience for a decade of construction and permitting, the capital to absorb billions in upfront cost, and the sophistication to negotiate concession terms that actually protect your pricing power, a well-located, well-utilized port can generate some of the most durable cash flow available anywhere in infrastructure, which is exactly why sovereign wealth funds and global logistics giants keep fighting over control of them. But this is not a passive investment, and the guaranteed monopoly story oversimplifies a business that is really a bet on trade routes, government relationships, and traffic forecasts holding steady for decades at a time. The ports that thrived, Singapore, Piraeus, the terminals along the busiest trade lanes on Earth, succeeded because demand showed up exactly where the infrastructure was built. The ports that failed didn't fail because the cranes broke down. They failed because a number on a spreadsheet, made years before the first ship arrived, turned out to be wrong. Every container that moves through a port tells the same story global trade has told for 60 years. The money isn't really in the box. It's in being the one place that box has no choice but to pass through, and in getting that bet right before the concrete is even poured. So you want to own a data center. Companies pay you rent, not for an apartment, for space inside a warehouse full of servers. They sign contracts for 5, 10, 15 years. They can't leave early. The internet runs through your building, and every company on Earth needs somewhere to put its computers. No customers walking away over price, no fashion trends, no seasonal slowdown, just racks of machines, humming quietly, generating revenue every second of every day, whether it's 3 a.m. on a Tuesday or Christmas morning. It sounds like the perfect business. Recurring revenue, long contracts, an industry riding the biggest technology wave in human history. Every AI company, every bank, every streaming platform, every hospital system needs more computing power than it did last year. Demand only goes up. So why doesn't everyone own one? Because building the thing costs more than most companies are worth, because the land has to sit on top of enough electricity to power a small city, because getting that electricity connected can take longer than building the building itself, because one bad lease, one empty building, one shift in technology can turn a billion-dollar asset into a liability overnight. On paper, this looks like the easiest business in the world. A box that holds machines connected to power and fiber, rented out by the square foot. Reality is very different. Somewhere between the pitch deck and the first year of operations, most people find out that data centers aren't real estate businesses. They're utility businesses wearing a real estate costume. And utility businesses live and die by numbers most investors never think to check: power contracts, cooling efficiency, interconnection queues, depreciation schedules on equipment that becomes obsolete in 5 years. So who actually makes money doing this? Who loses everything, and why is one of the most capital-intensive businesses on the planet suddenly the thing every billionaire wants a piece of? Let's start at the beginning. The story of the modern data center starts with the phone company. In the 1990s, telecom carriers built massive switching facilities to route calls and, later, internet traffic. These buildings needed enormous power capacity and physical security, so they were built like fortresses: thick walls, redundant electrical systems, no windows. When the dot-com boom exploded, these buildings suddenly had something more valuable than switching equipment. They had space, power, and connectivity, and every internet startup needed exactly that. That's how co-location was born. Instead of building their own server rooms, companies rented rack space inside someone else's fortress. Equinix, founded in 1998, became one of the pioneers of this model, buying up old telecom facilities and turning them into neutral meeting points where multiple networks could connect to each other. It was less about renting shelves and more about renting proximity, being physically close to the internet's central nervous system. Then the dot-com bubble collapsed in 2000, and half of these companies vanished. Equinix itself nearly went bankrupt, trading for pennies before clawing its way back. The survivors learned a brutal lesson early. This business only works with real customers signing real contracts, not startups burning venture capital on hype. For the next decade, the industry grew quietly. Banks, insurance companies, and government agencies needed secure places to store growing amounts of data. Then cloud computing changed everything. Amazon launched AWS in 2006. Microsoft and Google followed. Suddenly, the biggest customers in the data center world weren't renting a few racks. They wanted entire buildings, sometimes entire campuses, built to their exact specifications. This is where the business becomes interesting. Two very different companies emerged from that shift. Co-location operators like Equinix and Digital Realty kept leasing space to many tenants inside shared buildings, and hyperscalers, Amazon, Microsoft, Google, Meta, started building their own facilities from scratch because their scale made ownership cheaper than renting. Today, most new construction isn't co-location at all. It's hyperscale, built for a single tenant that has already signed a lease before the concrete is poured. That distinction matters more than almost anything else in this industry, and we'll come back to it. But first, let's talk about what it actually costs to build one of these buildings, because the number is enormous and it keeps climbing. In 2026, a standard data center costs somewhere between $8 and $12 million per megawatt of capacity to build. AI-optimized facilities, the ones packed with the dense computing needed for machine learning, run $15 to $20 million per megawatt or more, largely because of liquid cooling systems that didn't exist in mainstream construction a few years ago. A modest 50-megawatt facility, which sounds small by industry standards, can cost $400 to $600 million before a single server is installed. Where does that money go? Roughly 40 to 45% goes to electrical infrastructure, transformers, backup generators, uninterruptible power supplies, battery systems designed so that if the grid fails, computing never stops, not even for a second. Another 15 to 20% goes to cooling. Servers generate enormous heat, and if that heat isn't removed constantly, the equipment fails within minutes. The rest goes to the physical structure, security systems, fire suppression, and the fiber connections that link the building to the outside world. And that's before you've paid for land. Data centers need cheap, reliable power more than they need a nice location, so operators increasingly chase places like Virginia, Texas, and increasingly the Midwest, wherever utilities have spare grid capacity. That capacity is not guaranteed. In parts of Northern Virginia, the world's largest data center market, new projects have waited years just for the local utility to confirm a connection date. Power, not land, has become the real bottleneck of the entire industry. Then there's the equipment inside, servers, networking gear, storage arrays. None of it lasts. Server hardware typically depreciates over 3 to 5 years before it needs replacing, because faster, more efficient chips make older equipment obsolete. Imagine owning a building where a third of your most expensive asset needs to be replaced every few years, forever. That's not a one-time cost. That's a permanent, recurring capital expense baked into the business model. So here's the problem. You've spent $500 million, waited 2 to 4 years for permits, utility approval, and construction, and you haven't earned a dollar yet. This is a business where the money goes out for years before it starts coming back in, and that's only if everything goes according to plan. But that's only half the story, because once the building is running, the revenue side gets interesting fast. Data centers make money a few different ways. The simplest is base rent, charged per kilowatt of power, reserved for a tenant, whether they use it fully or not. Then there's power itself. Many operators charge for actual electricity consumption on top of the base fee, sometimes with a markup. Then there's interconnection revenue, which is where companies like Equinix quietly make some of their highest margin money. Every time one network needs to physically connect to another inside the building, a bank connecting to a cloud provider, a trading firm connecting to an exchange, that connection generates a recurring fee. It costs almost nothing to maintain a fiber cross-connect once it's installed, and companies pay for it every single month for years. This is why co-location companies obsess over network density. The more networks inside a building, the more valuable that building becomes to every other tenant, because everyone wants to be close to everyone else. It's the same logic that makes a shopping mall more valuable with more stores in it. Equinix has spent 2 decades building exactly this kind of network effect, and it's a large part of why the company trades as a real estate investment trust worth tens of billions of dollars today. Hyperscale is a completely different animal. When Microsoft or Meta signs a 15-year lease for an entire building, there's no interconnection revenue, no multiple tenants, no marketplace dynamic. It's simple, predictable, bond-like income, but it's also lower margin and entirely dependent on one company's continued need for that capacity. If Meta decides in 8 years that it no longer needs that facility, the landlord is left holding a building custom-built for one customer's exact specifications, in a location chosen for that customer's needs, not anyone else's. The numbers tell a different story depending on which side of this business you're standing on. Now let's talk about what nobody puts in the pitch deck: operating costs. Electricity is the single largest ongoing expense, and data centers are extraordinarily hungry. A large facility can consume as much power as a small city, and every watt used to cool the servers is a watt not generating revenue. Engineers measure this with something called power usage effectiveness, or PUE, the ratio of total power consumed to the power actually delivered to computing equipment. A PUE of 1.5 means for every watt reaching a server, another half watt is spent just keeping the building cool. The best hyperscale facilities have pushed PUE down toward 1.1, but achieving that took years of engineering investment that smaller operators simply can't afford. Then there's labor, specialized technicians who can be on-site 24 hours a day, because a data center cannot go dark for maintenance the way an office building can. There's insurance, which is expensive given the value of the equipment inside and the catastrophic cost of any downtime. There's property tax, often calculated on enormous assessed values. There's compliance, certifications for security, uptime, and data handling that customers demand before they'll sign a lease. And there's the debt. Because these projects are so capital-intensive, almost none of them are built with cash alone. They're financed with loans, and when interest rates rise, so does the cost of every project in the pipeline. And then something changed. Around 2023, the AI boom turned data centers from a steady infrastructure business into the most contested real estate on the planet. Suddenly, every hyperscaler wanted more capacity than the grid could deliver. NVIDIA's chips became so valuable that companies started signing power contracts before they'd even finished designing the building around them. Land near power substations in places like Texas and Virginia started selling for prices that would have been unthinkable a decade earlier. U.S. data center construction spending hit roughly $78 billion in 2025, and by mid-2026 spending had already quadrupled the prior year's pace. This is where the case studies get interesting, because the same forces that create fortunes in this business have also destroyed them. Consider Switch Inc., a Nevada-based data center operator that built one of the most efficient, renewable-powered facilities in the country, largely on the strength of a handful of massive anchor tenants. For years, it was a Wall Street darling. Then, as competition from hyperscalers who built their own facilities intensified, Switch found itself acquired by private equity in 2022 at a valuation far below its earlier public listing. The lesson wasn't that the business was broken, it was that even a well-run data center company is vulnerable when its biggest customers realize they can build it themselves cheaper than they can rent it. Now compare that to Digital Realty and Equinix, two of the largest publicly traded data center companies in the world. Both survived the dot-com crash, the 2008 financial crisis, and multiple technology cycles by diversifying their tenant base across thousands of customers instead of a handful of giants. When one tenant leaves, the building doesn't go dark. Dozens of others remain. That diversification is what allowed both companies to grow into real estate investment trusts worth well over $30 billion each, decades after they were founded in buildings originally meant for telephone switches. And then there are the disasters nobody plans for. In 2021, a fire at an OVH cloud data center in Strasbourg, France, destroyed one entire building and damaged another, wiping out data for customers who hadn't properly backed up elsewhere. It was a reminder that no matter how much redundancy a facility builds into its power and cooling systems, physical risk never disappears completely. Insurance covers some of it. Reputation rarely recovers as easily. Government decisions matter just as much as fires. In parts of Ireland, regulators have restricted new data center connections to the Dublin power grid because the sector was consuming a disproportionate share of the country's electricity, in some years close to a fifth of national demand. In the Netherlands, local governments imposed moratoriums on new hyperscale construction over land and water use. The business that looked immune to competition turned out to be vulnerable to something else entirely: the patience of the communities and grids it depends on. So what determines whether an operator wins or loses in this industry? Margins in data centers can look extraordinary on the surface. Established co-location operators often report operating margins above 40%. But that number hides the capital intensity underneath it. Depreciation on billions of dollars of equipment and infrastructure eats into that margin every single year, and the business requires constant reinvestment just to stay competitive, let alone grow. Free cash flow, the number that actually matters to investors, is often far thinner than the headline margin suggests, because so much of the earnings gets plowed straight back into new construction. Pricing power depends almost entirely on location and interconnection density. A data center in a major hub like Northern Virginia or Frankfurt, sitting inside a dense web of network connections, can charge a premium that a facility in a less connected market never could. That's the monopoly-like quality of this business. Not a monopoly on data centers generally, but a near monopoly on being in the one place everyone else needs to connect to. Now, where is all of this heading? Artificial intelligence has permanently changed the demand curve. Training large models requires enormous, sustained computing power, and every major tech company is racing to secure capacity years in advance. That demand isn't slowing down, but it's also concentrating power in the hands of a small number of hyperscale customers who increasingly prefer to build and own their own facilities rather than lease. That trend squeezes traditional co-location operators toward higher-value services like interconnection and away from simple space rental. Energy is the other defining constraint of the next decade. Grid capacity, not land or capital, is now the limiting factor on how fast this industry can grow. That's pushing operators toward nuclear power agreements, on-site gas generation, and long-term renewable contracts just to guarantee the electricity their buildings will need. Water use for cooling is becoming its own political flashpoint, particularly in drought-prone regions. And climate policy, still evolving in most countries, could reshape the economics of this entire industry within a single election cycle. So, should you buy one? If you have the capital, patience, and appetite for a business that behaves more like a power utility than a landlord, data centers can generate remarkably stable, long-duration cash flow, especially with diversified tenants and strong interconnection revenue. That's why pension funds, sovereign wealth funds, and private equity giants have poured hundreds of billions of dollars into this sector over the past 5 years. But this is not a passive investment. And it is not an easy business, no matter how the pitch decks make it sound. It demands enormous upfront capital with years of no return, deep expertise in power markets and engineering, exposure to interest rates, and dependence on grid infrastructure you don't control. A handful of customers can define your fate. A single regulatory decision in one country can freeze an entire pipeline of projects overnight. The data center business isn't free money disguised as real estate. It's a bet on the world's appetite for computing power continuing to outrun the world's ability to generate and deliver electricity. So far, that bet has paid off for the operators who understood the difference between owning a building and owning a utility. For everyone else who thought this was simply property with better tenants, the numbers eventually told a different story. So you want to own a Formula One team. 500 million people watch the sport every year. Your logo sits on a car that gets photographed at every Grand Prix, beamed into living rooms on 6 continents. The biggest brands on Earth, banks, airlines, watchmakers, pay you tens of millions of dollars just to put a sticker on your car. And if your team wins, you don't just get a trophy, you get a check from Formula One itself, sometimes worth over $100 million a year, just for showing up and performing. It sounds like the ultimate marketing machine, global exposure, glamorous partners, a built-in audience of the wealthiest consumers on the planet. So why do most Formula One teams lose money for most of their existence? Because building a competitive car costs more than the prize money could ever return. Because a single rule change from the sport's governing body can wipe out a technical advantage that took years and hundreds of millions of dollars to build. Because a lot of the money isn't actually going to the team you cheer for, it's flowing to Formula One management, the company that owns the sport itself. And because for every Ferrari or Mercedes printing money, there's a Caterham or a Marussia that went bankrupt chasing the same dream with a fraction of the budget. On paper, this looks like the perfect business, a permanent, scarce asset with global reach and no real competition for its spot on the grid. Reality is very different. There are only ever 10, sometimes 11 seats at this table. No one can simply start a new Formula One team the way you'd start an airline or a restaurant chain. That scarcity should make every team wildly valuable. And for the biggest names, it has. But scarcity alone doesn't guarantee profit, and for most of the sport's 75-year history, owning a team was less an investment and more an extremely expensive hobby for billionaires who could afford to lose money in public. So what actually changed? Where does the real money come from? And is Formula One ownership today a genuine business or still just the most glamorous way in the world to burn cash? Let's go back to the beginning. Formula One started in 1950, born out of European motor racing traditions stretching back to the 1920s. For most of its early decades, it was run by wealthy enthusiasts and engineers, people like Enzo Ferrari, who built his team as an extension of his road car business, and later privateers like Frank Williams, who quite literally slept in his van early in his career just to keep his fledgling team alive. Teams were funded by sponsorship, prize money, and the personal fortunes of their owners. There was no cost control, no shared television revenue model, and for decades, the commercial side of the sport was chaotic and underdeveloped. Then something changed. In the late 1970s and through the 1980s, Bernie Ecclestone consolidated the commercial rights to Formula One, essentially turning the sport into a media and licensing business. He negotiated television deals, centralized sponsorship, and built the financial architecture that still defines the sport today. One entity, Formula One Management, controls broadcasting rights and race hosting fees and distributes a share of that revenue back to the competing teams. Ecclestone effectively became the landlord of the entire sport, and the teams became his highest profile, most expensive tenants. In 2017, Liberty Media, the American media conglomerate, bought Formula One's commercial rights holder for approximately $8 billion, taking over from the private equity firm CVC Capital Partners, which had owned the sport for over a decade. This is where the business becomes interesting, because Liberty didn't just want race hosting fees. They wanted Formula One to behave like a modern media property. More races, more markets, more streaming content, and critically, the Netflix series Drive to Survive, which launched in 2019 and introduced the sport to an entirely new American audience that had never watched a Grand Prix in their lives. That single show changed the economics of team ownership more than almost anything else in the sport's modern history, and we'll get to exactly how. So who buys a Formula One team today, and how do they actually get in? There is no open marketplace where you simply purchase a slot. The grid is capped, currently at 10 teams, expanding to 11 with the arrival of Cadillac in 2026, and a new entrant has to apply through Formula One's official process, demonstrating financial backing, technical capability, and a viable long-term plan. Even then, acceptance isn't guaranteed. The Andretti organization, backed by General Motors, spent nearly 2 years fighting for entry before finally securing a place on the grid as Cadillac. And that entry doesn't come cheap. Under the current Concord Agreement, the commercial contract binding the teams, the FIA, and Formula One management, any new team must pay what's called an anti-dilution fee, compensating existing teams for the reduced share of prize money that comes from splitting the pool an extra way. That fee was originally set at $200 million in 2020. By the time Cadillac's entry was finalized, the actual figure had risen to approximately $450 million, split evenly among the 10 existing teams, roughly $45 million landing in each of their bank accounts before Cadillac had even built its first car. So here's the problem. That $450 million entry fee is just the cover charge. It doesn't build you a car, hire your engineers, or construct your factory. Industry estimates suggest Cadillac's total commitment before turning a single competitive lap, entry fee, facilities, staff, engine supply arrangements, and driver contracts, approaches roughly $1 billion. And then there's the annual cost of simply competing, which is where Formula One's most important financial innovation comes in: the cost cap. Introduced in 2021 after years of unchecked spending drove smaller teams toward bankruptcy, the cap limits how much a team can spend annually on car development and performance, explicitly excluding driver salaries, marketing, and the top 3 executives' pay. For the 2025 season, that cap sat at approximately $140.5 million. For 2026, alongside sweeping new technical regulations covering aerodynamics and hybrid power units, the cap rises to approximately $215 million, a jump of roughly 30% in a single year, timed precisely to accommodate the engineering overhaul the entire grid is undertaking simultaneously. That cap changed everything about how this industry works, because for the first time in the sport's history, spending power alone couldn't buy dominance. Teams still had to be smart, not just rich. Now let's talk about where the money actually comes from, because Formula One team revenue breaks down into several very different categories, and not all of them are created equal. The first is prize money, distributed by Formula One management based on a team's finishing position in the previous season's Constructors' Championship, plus a base payment every team receives just for competing. Top teams like Ferrari, Mercedes, and Red Bull can pull in $80 to over $100 million a year from this alone. A brand new team with no championship history, like Cadillac in its first season, might expect closer to $40 to $55 million, a meaningful sum, but nowhere near enough to cover a $215 million cost cap on its own. That gap gets filled by sponsorship, and this is where the business becomes genuinely lucrative for the teams that get it right. Title sponsorships, the kind that put a company's name directly into the team's official title, like Oracle Red Bull Racing or Scuderia Ferrari HP, can be worth tens of millions of dollars a year. Secondary and technical partners add tens of millions more. This is the revenue stream Drive to Survive transformed most directly. The show didn't just grow television viewership, it made Formula One sponsorship dramatically more valuable to brands trying to reach a younger, wealthier, increasingly American audience. And sponsorship rates across the grid climbed sharply in the years following its release. Then there's manufacturer backing, relevant for teams owned outright by car companies. Ferrari, Mercedes, and now Audi through its majority stake in Sauber, and General Motors through Cadillac. These teams benefit from engineering resources, brand marketing budgets, and financial backstops that independent, privately owned teams like Haas or Williams simply don't have access to. And finally, there's the value of the franchise itself. Unlike prize money or sponsorship, this isn't annual revenue. It's what the team is worth if you decide to sell it, and this number has exploded over the past decade in a way almost no other sports asset has matched. Williams offers the clearest case study of just how dramatic that shift has been. In 2020, the storied Williams team, struggling financially, sitting near the back of the grid, was sold to the American investment firm Doralton Capital for approximately £152 million, roughly $200 million at the time. It was widely seen as a distressed sale of a fading name. 5 years later, with Formula One's global audience and commercial value transformed, reports around subsequent investment and minority stake activity in the team have pointed to valuations reaching well into the billions, an increase that would represent one of the most dramatic value appreciations of any sports franchise in modern history, achieved without the team winning a single championship in that period. The car didn't get radically faster. The business the car belongs to got radically more valuable. But that's only half the story, because for every Williams there's a Caterham or a Marussia, two teams that entered the grid in 2010 during an earlier cost control initiative, spent years struggling at the back of the field, and both collapsed into administration within months of each other in late 2014. Neither had the sponsorship base, manufacturer backing, or prize money share to sustain the ongoing cost of competing, even at that era's lower spending levels. The lesson was brutal and simple. Scarcity of grid slots protects you from new competitors, but it does nothing to protect you from your own balance sheet if the revenue never catches up to the costs. Force India tells a similarly cautionary story. Founded by Indian businessman Vijay Mallya, the team competed respectably through the 2010s, but Mallya's broader business empire collapsed under fraud allegations and unpaid debts, dragging the team into administration in 2018 mid-season. It was rescued at the 11th hour by a consortium led by Canadian billionaire Lawrence Stroll, relaunched first as Racing Point and later rebranded entirely as Aston Martin, now one of the most heavily backed teams on the grid. A reminder that in this sport, the difference between collapse and reinvention often comes down to finding one investor with deep enough pockets at exactly the right moment. So what do the industry's actual economics look like once you strip away the glamour? Margins vary enormously by tier. The top 3 or 4 teams, with strong sponsorship, manufacturer backing, and consistent championship prize money, can be genuinely profitable businesses, generating tens of millions of dollars in annual profit, even under the cost cap's constraints. Mid-grid and backmarker teams often operate near break-even or at a loss, dependent on their owners' willingness to keep funding the gap between costs and revenue, year after year, in the hope that better results eventually arrive. Debt plays a smaller role here than in most capital-intensive industries, largely because the cost cap limits how much teams can spend regardless of how much they could borrow. A deliberate design choice by the sport's governors to prevent the kind of reckless overspending that bankrupted teams in the 2000s and early 2010s. Instead, the real currency in this business is investor patience. Owning a struggling Formula One team means accepting years of underperformance and financial strain in exchange for a scarce, appreciating asset and the possibility that better results and better sponsorship deals eventually arrive. Pricing power in this business doesn't really belong to the teams at all. It belongs to Formula One management, which controls the broadcast deals, the race calendar, and the overall commercial direction of the sport. Teams negotiate individually for sponsorship, but the biggest revenue lever in the entire ecosystem, how much broadcasters and race host cities pay to be part of Formula One, sits entirely outside any single team's control. And that's when everything falls apart or comes together, depending entirely on the regulations. Every few years, Formula One rewrites its technical rulebook, and those transitions can reshuffle the competitive order almost overnight. Mercedes' dominance from 2014 to 2020 stemmed directly from a hybrid engine regulation change other manufacturers were slower to master. Red Bull's dominance beginning in 2022 followed a completely new aerodynamic rulebook that rewarded teams who understood the new ground effect regulations fastest. The 2026 regulations, new power units, new aerodynamics, new fuel requirements, represent exactly this kind of reset moment, and it's precisely why Audi and Cadillac chose this window to enter. The playing field resets, if only briefly, closer to level. So where is this industry heading? Sustainability regulation is reshaping the sports engineering roadmap directly. The 2026 power units are built around fully sustainable fuels and a much higher proportion of electrical power, a shift Formula One has framed explicitly as preparation for a future where combustion engine road cars become increasingly rare. That technical direction matters commercially too, because manufacturer participation depends heavily on Formula One remaining relevant to what car companies are actually trying to sell on the street. The American market remains the sport's biggest growth opportunity and its biggest open question. 3 United States Grand Prix now run each season: Austin, Miami, and Las Vegas, a level of American exposure the sport never had a decade ago, and Cadillac's entry is as much a bet on capturing American attention as it is a racing program. Whether that audience continues growing or whether the drive to survive-driven surge in interest plateaus will shape sponsorship values across the entire grid for years to come. So, should you buy one? If you have patience measured in years rather than quarters, deep enough pockets to survive seasons where results lag behind spending, and a plan for building sponsorship and manufacturer relationships that outlast any single driver or technical era, Formula One team ownership has become, for the first time in the sport's history, a genuinely appreciating financial asset, not just a billionaire's expensive hobby. But the sport hasn't stopped being brutal to those who get the timing or the execution wrong. The cost cap limits how much you can lose, but it does nothing to guarantee you'll win, and a grid slot only becomes valuable if the team behind it eventually competes. For every Williams sale that multiplied an owner's investment many times over, there's a Caterham, a Marussia, a Force India that reminds you scarcity protects your seat at the table, not your bank account. Formula One didn't become a good business because the racing changed. It became one because a media company finally figured out how to sell the story around the racing to the entire world, and the teams smart enough to understand that shift early are the ones now sitting on assets worth more than most of them ever imagined possible.